We're
Okay,
live.
we haven't done a book reading in a bit. We're reading from our book, Bitcoin 1 Million.
You can follow along if you have the book at home.
Yeah, you can follow along. British Hodl just recently gave us a little shout out. So
you like the book?
he didn't like it because he hasn't read it, but a friend of his bought it. And he goes, I was telling them to use it as bonfire. But, anyways, he actually said, no, you should go out and buy this book. If you don't buy it, you're a wanker. That's what he said. That was literally his words.
Does that review count? He didn't even read the book.
No.
Does he read books?
He does not read.
Okay. So British Auto recommends our book, but he doesn't read it.
He does.
That's the latest. So today we're going to be reading from chapter 11, Stablecoins. It's been a while since we did a reading. We've been a little bit busy. But
why would stablecoins be in a book about Bitcoin?
Yeah, let's talk about it real quick. Well, I think that, one thing is that people don't want to spend Bitcoin.
That's true.
And so we learned that because we built an app that made Bitcoin really easy to send and receive without fees. And we also monitor these things pretty closely to see kind of transactional volume on Bitcoin over the years versus transactional volume on, for example, Tron.
Yeah.
And other stablecoin networks. And it turns out stablecoins are blowing away Bitcoin as a means of exchange. So people buy Bitcoin, they don't want to sell it, they don't want to spend it.
And we don't really recommend that they do.
So now we've kind of switched to, we're switching into a stablecoin world. There's all these stablecoins. It's pretty fascinating. It's not really covered in this chapter, but something that's happening right now is all the big major banks in the world are creating stablecoins. Probably Starbucks can create a stablecoin. Literally Visa, MasterCard, all these people are creating stablecoins. And we have all these incompatible stable coins, but it is a bridge to adopting Bitcoin for many people because it's a conceptual jump that they make into digital currency in general. And
so we covered in the last couple of chapters,
the
ETF and MSTR, kind of how institutions are adopting Bitcoin and how it's being used to save as a savings mechanism. But now in the next couple of chapters, which is this and the fast Bitcoin, we want to talk about how Bitcoin actually is going to be held and it's going to evolve into actually a means of exchange. And ultimately, we believe
we're about halfway through.
About halfway through
the book of chapter 11. There's 21 chapters, and the first half of the book, like Fred's saying, is dealing with the money printer, the power law, other asset classes.
Yeah, a little quick review. I want to just review the 10 chapters that we covered. So real quick, so let's go back to why do we write this book and why this book is useful as a reference to you. So, I would say the main reason we wrote this book is we wanted to give a mass market book that any person who is investing money can use to make an intelligent allocation to Bitcoin, an intelligent financial allocation.
This book does not answer the question, what is Bitcoin?
No.
You're not going to find that in here.
We have a book. So we started.
Just backing up a little bit. We do have another book.
We started this book.
More of the question, what is Bitcoin? And more of the history of Bitcoin.
Now this book.
Open it up so we can see.
Okay, so this book is the big Bitcoin. This book was a labor of love. And this is a book really about the history of Bitcoin, right? So this book we wrote with Lee Steffen, our art director. And this is just an amazing, beautiful book. It's a coffee table book. There's still, how many copies are there left?
About 300, I think.
There's 300 left. They're extremely, and there will never be another big Bitcoin book. So it's really amazing. There was 2,100 that were ever printed. 1,000 in the numbered first edition and 1,100 in the second edition. And that's it. And it's a beautiful book and it's printed on this, in high color on this beautiful paper. And, it's an art book, so you get stuff like this, you really see. And there's no more beautiful book on Bitcoin, but this is really the history of Bitcoin. It's not about how's Bitcoin going to make me rich or should I buy more Bitcoin? It's really just the history of it. And because we love Bitcoin so much, We wanted to kind of talk about all the people that, came before Bitcoin, and people like Adam Back, or people like my friend Cynthia Dwork, who invented proof of work, or David Chong, who invented cryptocurrency. So that's the history of Bitcoin. This is the future of Bitcoin, right? So that's kind of where we started.
Yeah, I mean, this is a very different kind of Bitcoin book because it's kind of combining, Fred and I have some different viewpoints, even though we write these things together, and we have some different levels of understanding about Bitcoin, which is kind of what makes us such a good pair, a good team, is that Fred understands financial markets really well. If you're a Bitcoiner who does not understand what CAGR is, what Shiller PE ratios are, Case-Shiller index is, this is a book for you. Sharpe ratio, Kelly criteria.
Right.
This is a financial education tool for you. And it's really important, obviously, to be educated financially. And honestly, I'll tell you, learning all of these things and seeing the charts in this book only made me even more bullish on Bitcoin.
Right. And so basically we want to kind of provide everything here as far as all the tools to start. And like the first tool was chapter 1, which we covered here, is the power law. And I'm not aware of any Bitcoin book that really has covered the power law. It's amazing because this is such an important reason. It's such an important discovery, this power law, right? Which is all these statistics. Yeah.
It's really, this book is a book of amazing charts with some stories in it.
Yeah.
Stories weaving together charts, and the charts are all very simple to understand. And when you start to see all these charts stacking together, it makes the path to 1 million inevitable, right? Is what I will tell you. So
the first part is, the power law, which is really a story of adoption, which is how is this new instrument being adopted, right? And why, over now the last 17 years since the white paper came out, how has the growth been? The growth in the price, the growth in the addresses, the growth in hash rate, all these things point to a very clear statistical path. And it's very unlikely, given the correlations that we've seen, very unlikely that it does something completely different in the next 17 years, right? So, while we can't completely predict the future, we can tell you what statistically will happen. Now, we can't predict the population growth of Nigeria either perfectly, but we can tell you that
general trend.
We can tell you that if it's growing 5% a year for the last 20 years,
it'll probably continue.
Probably going to continue at 5% a year for the next 20 years, right? And so very much there's a lot of statistics in this book. It's not just math, it's statistics.
But the power law chapter really does a good job of explaining why Bitcoin is unique compared to every other asset that's ever existed. And that it follows this natural growth pattern that's found in nature and in cities and in everything that grows that has limits, and it's very interesting the way that this comes out is because the power law, it's not that it exists or doesn't exist. One of the things that I find people commenting is like, power law, does it exist for other assets? Does it exist for the S&P? Does it exist for M2? And the answer is that it exists for everything, but it doesn't fit, right? It's very important to understand. I think this is what we cover really well in here, is this idea of correlation.
Yeah.
That you can measure anything with a different statistical model. And the two that we really talk about in this book are very simple. One's exponential and one's the power law. And you can look at Bitcoin as an exponential, but the fit is not as good as the power law. And you can look at the S&P as a power law, but the fit is not as good as exponential. And the fit is everything. Just because you fit inside a size 14 size shoe, doesn't mean size 12 is not really your size. So the size for the shoe is what fits. And the shoe that fits Bitcoin is the power law.
And chapter 2, which is the money printer, the shoe that fits the money printer is exponential, right? It's an exponential curve, right? So you have an exponential.
But look at this money supply chart. This is a great chart.
Yeah.
Money supply chart.
Yeah.
So this is the assets, money supply of the world. It's an amazing chart.
So and it's not just the Federal Reserve, it's China, it's the Eurozone, it's the yen, right? So Chapter 2 really kind of tries to explain how the money supply has been growing, and it's not just the Democrats. It's not.
And also how asset prices change over time,
right.
and how different assets for different classes change at different rates. Really, really interesting stuff that you just are not going to find in other books.
Right. Chapter 3, we really dive into inflation now. I think there's a lot of really bad information on inflation in Bitcoin spaces. A lot of people are like, Fred, cheeseburger is going to be $100 in 10 years. No, cheeseburger is not going to be $100 in 10 years. Cheeseburgers have gone up. The Big Mac in 1971 was 65 cents. Okay. It's gone up less than 10x in 50 years. Okay. So it's not going to go up 10x in the next 5 years or 10 years. It will not. Like, it took 50 years for the cheeseburger price, and it still hasn't doubled. So the annual price of a cheeseburger is going at a 4.1% annual rate. Now, on the other hand, if you look at a Patek Philippe, okay, or a private jet, or Aspen Real Estate, or a Gulfstream G650, okay, these things have gone up at 12% a year or 16% a year,
which is like 2 to 3x.
Yeah. So if you're in the market for a Ferrari 488, that's going to go up really fast. Okay.
And this kind of plays into the post I was making. The point is that when you start looking at these numbers, what you realize is that like assets go up in value, and so basically one thing that separates the rich from the poor, it's kind of rich dad, poor dad stuff, is like if you're spending your money in investing into assets, well, you're going to end up better off than people who aren't. Bitcoin happens to be the best asset to invest in our opinion. That's part of this book. That's why all of these chapters, if you already understand this stuff, you may not understand how it relates to Bitcoin. If you understand Bitcoin, you may not understand these things.
Yeah. Right? So chapter 4, we start going into,
how money's made.
Should I put my money in Bitcoin or should I put my money in stocks? Okay. Pretty valid thing because we all own a little bit of stocks.
I have friends that still don't own Bitcoin. They say, I don't play that game. I invest in stocks, only bonds.
Now, if you look at it on an annual basis, you see in 2015, Bitcoin was the winner over the S&P. In 2016, Bitcoin is the winner. In 2017, Bitcoin is the winner. In 2018, S&P was the winner, but it lost money.
Everything lost.
Right. So it lost the least.
The S&P lost less than Bitcoin, but actually in that year, I think bonds lost less than the S&P.
And so on and so forth. But basically in the last 9 years, you've had 2 years where the S&P won. So,
but actually in both those years, either gold or bonds were a better winner. So
that's right.
The S&P actually didn't win when you look at all the asset classes.
So, we look at the stock market, we look at kind of how it's earning its return, and our goal is basically not to completely tell you that the stock market is a terrible investment, because I think it actually is a better investment than the bond market, which we get into in chapter 5, which we basically just hate. And basically, but neither stocks nor bonds are going to deliver the kind of return that Bitcoin's going to do. That's the bottom line. Chapter 6, we deal with the biggest asset class in the world, which is real estate. And we make the really good, now real estate gives you a lot of security. People feel very secure knowing that they own like a rental apartment building.
Yeah, but then you look at charts like this, the price per median income, and you just see it's been completely skyrocketing for 15 years. So
probably not a great investment. Unless people figure out how to make tons more money, they're pretty much tapped out at this point.
Well, it just seems like real estate's got to come down with all the people losing jobs, and the job loss is going to keep increasing. There's no way that it can sustain.
Chapter 7, we debunked this idea that gold is somehow a great investment, right? Some people are like, well, gold, Fred, gold, and gold sucks. Okay. Gold, Bitcoin's had in a power law versus gold. That's almost the same power law versus fiat, by the way. And yet it's had a little bit of a run recently, but overall gold sucks. Okay. And, if you're long gold and you don't own any Bitcoin, you need to go see some medical advice. In chapter 8, we talk about the ETF. That's kind of where I got really excited about Bitcoin with the ETF, and I went online a lot. And ETF changed everything because ETF opens up Bitcoin as an asset class to all these investors. And then in chapter 9, we talk about MSTR and the Bitcoin treasury phenomenon. And then
which has basically your valuation.
I do have some math in there.
Really good.
Yeah, I worked out some math.
And you've already used this math to make money.
Yeah.
Recently.
Yep. Here's the math. Here's the math on Bitcoin. I bet you Saylor hasn't actually worked out these formulas. But anyways, that's the math. So that's that. And then we have chapter 10 is bit bonds. And, look, I think this is a really interesting structure. It's very hypothetical. But I do think that we are ultimately going to be issuing hybrid bonds that have the payment has some Bitcoin component to it, because people are going to demand it. People are going to want, okay, you're giving me 5% a year, but you're giving me my money back in 5 years. How
We're bullish on this concept in general of like a Bitcoin yielding product where you get a kicker.
And look, I think MicroStrategy, or Strategy as it's now called, should issue some of these bit bonds. I mean, they're doing other things, but bit bonds are very appealing things. So that brings us to where we are.
Stablecoins.
So now we're going to read chapter 11.
Getting into it.
And go ahead. Let me start.
So stablecoins, they're not competing with Bitcoin. They're building its highway to $1 million. From a struggling startup in 2014 to a $200 billion market processing more volume than Visa, stablecoins have become the perfect Trojan horse for cryptocurrency adoption. Every business that accepts USDC, every bank that integrates Tether, every user who learns seed phrases through stablecoins is unknowingly preparing for the Bitcoin standard.
Now, let me read the next section. This is kind of personal.
Yeah.
The accidental beginning. Well, I was there at the birth of stablecoins, though I didn't believe in them at the time. In late 2013 in Los Angeles, I knew Brock Pierce and Reeve Collins. Reeve used to work for me. Brock was pioneering virtual currencies in gaming. So we brainstormed about creating a dollar-denominated stablecoin, leading to RealCoin, later renamed Tether. Initially, I was unimpressed. I watched the struggling startup fail to secure banking support, unable to find a single financial institution that would touch it. When Bitfinex acquired it in 2015, I thought the experiment was over. That assessment proved completely wrong. Once Bitfinex took control, Tether exploded. They had discovered the perfect product market fit. Tether could serve as the stablecoin trading pair for buying and selling Bitcoin, then Ethereum, then everything. Traders could move in and out of volatile positions without ever touching the traditional banking system. What had been a struggling startup suddenly became the lubricant for the entire crypto trading ecosystem. We thought we were creating digital dollars, but we accidentally created the training wheels for the worldwide cryptocurrency adoption. Go ahead.
From trading to survival. For years, stablecoins remained a trader's tool, a way to cash in on your gains without cashing out to banks. But the pandemic changed everything. As inflation exploded globally and banking systems faltered, stablecoins transformed from a trading instrument to a survival tool. In Lebanon, the banking system collapsed. Citizens couldn't access their own accounts, ATMs ran dry, capital controls trapped savings, but USDT on Tron still worked. Remember when that woman lit herself on fire?
Oh, yeah.
And like another guy was in there with a gun threatening employees, like just to get their money out of the bank.
Yeah.
They weren't trying to rob the bank. They were trying to get their own money in Lebanon. It's crazy. So a bartender in Beirut could receive payment from relatives in Detroit instantly, bypassing the failed banking system entirely. Now, Argentina limited dollar access to $200 monthly. while the peso lost 100% annually. The government couldn't limit internet access, though. Through VPNs and peer-to-peer markets, Argentinians moved billions into Tether, preserving wealth while their currency evaporated. Turkey, Nigeria, Zimbabwe, the pattern repeated. Governments trying to force citizens to use collapsing local currencies discovered a reality. You can control the banks, but you can't control the internet. Stablecoins became the Trojan horse for dollar strength, penetrating countries where traditional dollars couldn't reach. In these countries, stablecoins provided the only reliable way to preserve wealth as local currencies collapsed.
So this is a graph.
Great graph, yeah. Just
This
the growth of stablecoins.
growth of stablecoins, amazing growth. And you can clearly see 2020
Power law growth? Power law?
exponential growth, yeah. The graph is really amazing because we were at below 25 billion
It is
in
amazing.
2020.
It is amazing.
Okay, we've 10x'd the number of stablecoins. 10x.
Transactional volume
Yeah.
relative to the total assets, though, even back then was massive.
Yeah.
It was massive. So, the $10 trillion opportunity. Stablecoins grew from 1 billion in 2017 to 200 billion today. By 2035, they'll reach $10 trillion. These projections follow current growth trajectories. Global M2 exceeds 100 trillion. As banking infrastructure modernizes, at least 10% will tokenize as stablecoins. JP Morgan already processes 10 billion through JPM coin. PayPal's PYUSD reached 1 billion market cap for its first year, and Visa and MasterCard announced stablecoin settlement networks. But the real catalyst is the Genius Act. The Trump administration faced a problem. The US has an enormous deficit, and traditional buyers like China and Japan are reducing their treasury holdings. The solution? Require all stablecoins to be backed by US treasuries. Every Tether, every USDC must hold treasuries as collateral.
If they want to operate.
If they want to operate in the US. The mechanism is straightforward. As stablecoins grow to $10 trillion, they create 10 trillion in automatic treasury demand. The deficit gets funded, the dollar gets stronger, and cryptocurrency becomes legitimized. Within 5 years, you'll buy stablecoins at B of A. Your banking app will show USDC alongside your checking balance, and converting between them will be as simple as moving money between accounts. At least we hope. Here's the chart of the daily volume and market cap of these. Yeah, pretty cool.
Which is amazing. We went from 100 million in daily volume to an estimated 10 trillion. So we went from millions to trillions. I mean, that's going to be amazing.
It's going to be amazing. But the thing is, there's all these stable coins. The new sort of FX is just trading these stable coins for one another.
Yeah.
They're just completely incompatible. It's going to be very interesting to see all these exchanges and how they deal with all these different coins.
All right, let me read the banking revolution.
Yeah.
Banks are already building the infrastructure. They see stablecoins solving real problems. Instant settlement instead of 3-day ACH, 24/7 availability instead of banking hours, programmable money instead of dumb deposits. For interbank settlement, stablecoins are revolutionary. Currently, banks use SWIFT and correspondent banking, slow, expensive, opaque. With stablecoins, Bank of Tokyo can settle with Bank of Brazil instantly, 24/7, with complete transparency. Settlement risk disappears. Costs drop 90%. The implications cascade through the entire financial system. When banks use stablecoins for settlement, they need stablecoin liquidity. When they need liquidity, they become buyers. When they become buyers, they integrate retail services. Each step reinforces the next. Merchant pay paradise. For businesses, stablecoins solve every payment pain point. No more bounce checks. No more $50 wire fees. No more wondering if payment cleared. Most importantly, no chargebacks. Merchants lose billions annually in fraudulent chargebacks. Credit cards allow dispute for 180 days. PayPal and Stripe can freeze accounts for months, holding your money hostage. With stablecoins, your payment is final. You control your money. Cross-border commerce becomes frictionless. A developer in Bangladesh invoices a client in Berlin and receives payment instantly. Same experience whether the customer is in Tokyo or Toledo. No foreign exchange fees, no correspondent banks, no delays. Small merchants love this simplicity. No lengthy applications, no credit checks, no KYC friction. generate a wallet address, and start accepting payments. The same payment rail worked for the food truck in Bangkok or a Fortune 500 company. Travel sites know the fraud protection nightmare. Book a flight, card gets flagged, call your bank, wait on hold, verify the transaction, try again, maybe it works. Often the deal expires during this process. With stablecoins, transactions always work. No false fraud flags, no unusual activity blocks, no calling your bank from overseas. For digital goods, software, subscription, gaming items, stablecoins are perfect. Instant payment enables instant delivery. Micropayments become viable. Pay per article, pay per song, pay per API call. AI agents can transact with each other without human intervention. Go ahead.
Better yields than banks. Traditional banks pay 0.5 to 2% on savings. Stablecoin lending pools pay 5 to 10%. The yield is real, sustainable, and driven by genuine demand for leverage. Traders need to borrow stablecoins to go long. Arbitrageurs need capital for opportunities, and market makers need liquidity. Through protocols like Libre, you can use Bitcoin as collateral to mint stablecoins and earn yield. Deposit Bitcoin, mint stablecoins, lend them out. Earn 8% while your Bitcoin appreciates 42% annually. Never sell your Bitcoin while accessing liquidity and earning income. Borrow stablecoins against Bitcoin at 3%, lend them at 8%. Pocket the 5% difference. As Bitcoin appreciates, your collateral improves, allowing more borrowing. The system functions exactly as designed, creating sustainable yield through genuine market demand. Man, there's a million versions of this too, beyond Libre, but
yeah,
we'll talk more about Bitcoin lending in another chapter.
Let me do the remittance revolution. The $700 billion global remittance market is ripe for disruption. Western Union charges 5 to 10% and takes 3 to 5 days. Millions of immigrant workers lose billions to these predatory fees. Stablecoins, and by the way, Western Union is building a stablecoin on Solana.
Yeah, right.
Okay. Stablecoins cost pennies and settle instantly. A construction worker in Dallas can send money to a family in El Salvador immediately. A nurse in London can support parents in the Philippines without fees. The savings compound, that 10% fee saved is 10% more food, medicine, and education. Every immigrant worker who discovers stablecoins becomes an evangelist. They tell their friends, their family, coworkers. Once a remittance corridor accepts stablecoins, it never goes back to a traditional system. You want to go?
Yeah. The controversy that strengthened crypto. Tether's history isn't clean. For years, they refused to clearly state what backed USDT. Speculation ranged from Bitcoin itself to promises from other exchanges to commercial paper from unknown entities. Almost certainly, some of Bitcoin's leveraged growth in pre-ETF cycles was driven by unbacked stablecoin issuance. Tether, the sketchy, unregulated stablecoin, has actually weathered every crisis better than USDC, the fully regulated alternative. When Silicon Valley Bank collapsed in March 2023, USDC traded at 87 cents, while USDT held its peg perfectly. Decentralization proved more resilient than regulation. Tether operates where others fear to tread. In China, where crypto is banned, USDT is the primary medium for international trade. In Russia, under sanctions, USDT enables commerce. In Iran, cut off from SWIFT, USDT connects to global markets. Stablecoins work precisely because they operate outside traditional control structures. They serve the excluded, the sanctioned, and the unbanked. The education layer. Every stablecoin user unknowingly trains for Bitcoin. They learn seed phrases, those 12 to 24 words that control their money. They understand not your keys, not your coins by practicing with dollars first.
That's a really interesting point.
It's really true.
Not your keys, not your coins is not a Bitcoin concept.
Exactly.
It's a general cryptocurrency concept.
Yeah, they can still have sovereignty in a different way.
Right.
Not exactly the same as Bitcoin.
No.
Because it's tied to the value of a dollar being a stable.
Well, and because it can be frozen, essentially.
They do get frozen.
A lot of Tether gets frozen. I mean,
I've seen it happen.
I look at the percentage; it was like 5%. I mean,
these basically all the major exchanges in the world where the off ramps are for these things have a chat where they talk about giant hacks that happen and then freeze these things. Now, of course, that they're doing their own form of governance there. But the fact that it can be frozen at all is what's interesting in that sense. So what makes it different? It's interesting what makes it different from Bitcoin. So anyways, these are practical skills that you learn through daily use. A shop owner in Lagos accepting USDT masters the same wallet software that holds Bitcoin. A freelancer in Manila receiving USDC payment learns the same private key management needed for Bitcoin. Stablecoins remove volatility from the learning curve. Mistakes cost dollars, not appreciating Bitcoin. Once comfortable with stablecoin self-custody, Bitcoin becomes trivial. The same wallet, keys, and infrastructure work for both. So MetaMask uses MetaMask, for example. You can use both USDC and wrapped Bitcoin, and even Bitcoin. I think they support in some version of it. Yeah. Hardware wallets still store both stablecoin and Bitcoin. Exchanges that list USDC also list BTC. The Bitcoin-backed evolution. The next evolution is already beginning. Bitcoin-backed stablecoins. Instead of treasuries as collateral, use Bitcoin. Institutions deposit Bitcoin, mint dollar-denominated stablecoins, maintain exposure to Bitcoin appreciation while accessing dollar liquidity. Small experiments today will become major products tomorrow. As Bitcoin reaches $1 million, using it as collateral becomes even more attractive. Why sell appreciating Bitcoin when you can borrow against it at near zero rates? MicroStrategy pioneered this model with convertible bonds, and the next step is tokenization. Issue stablecoins backed by Bitcoin reserves. As Bitcoin appreciates, the backing strengthens. This creates the ultimate convergence. Bitcoin provides the collateral, stablecoins provide the liquidity, Lightning, or something similar, provides the rails. One integrated system where users seamlessly move between saving in Bitcoin and spending in dollars, savings and checking.
All right, let me read the next. The inevitable path to Bitcoin. I remember the title of the book, Bitcoin 1 million. So we're getting to $1 million, guys. The progression from stablecoins to Bitcoin follows predictable stages. First, local currency crisis drives stablecoin adoption. The peso collapses, the lira crashes, the Turkish lira, the naira becomes worthless. Citizens flee to digital dollars for stability. Now, I got to tell you, naira, these are some of the biggest countries for Bitcoin. In Nigeria, okay? Nigeria, people don't realize how big Nigeria is, right? Nigeria is going to
population-wise, yeah. It's going to become one of the biggest countries in the world.
It's going to be much bigger than the U.S. Okay? Nigeria is going to have more people in it than the U.S. in what, 20 years?
Something like that, yeah.
It will be 500 million people living in that place.
It's already a huge country,
right? So they per capita right now, they're buying.
They have a ton of Bitcoin.
They have a ton of Bitcoin.
Yeah.
And we talked to a bunch of Nigerians, and they're like, yeah, we of course, buy Bitcoin.
There's a Nigerian Bitcoin entrepreneur that we know, Gideon.
Yep. Yeah. Yep. So second, stablecoin users teaches cryptocurrency fundamentals. Users learn wallets, blockchain confirmations. They become comfortable with self-custody. Third, users discover stablecoins lose 7% annually to inflation.
Back to the means, motive, and opportunity.
Yeah. The first thing they're like, oh, great, I can hold dollars. And then the second thing is like,
oh, shit, I'm holding dollars.
shit, I'm holding dollars. So meanwhile, Bitcoin appreciates 42% annually on average against all fiat currencies. Fourth, gradual portfolio shift begins. Start with 75% stablecoins, 5% Bitcoin. As comfort grows and Bitcoin appreciates, the allocation shifts 80-20, then 60-40, then majority Bitcoin. Finally, Bitcoin becomes a savings account. Stablecoins, the checking account. Long-term wealth in Bitcoin, short-term liquidity in stablecoins.
We've been singing this song for years.
And so it's very simple. Why stablecoins guarantee Bitcoin's victory? Okay. So here this table has a table of the infrastructure adopted. So crypto exchanges, there's 500 million users total. Integration is complete. They all take stablecoins. Traditional bank, integration, they're building. Retail merchants, very early stage. They don't take, you go to your Starbucks, they don't take stablecoins, but that is coming. It is coming, okay? Cross-border payments, growing, right? People are starting to use stablecoins to settle cross-border.
Well, the companies,
The companies, yeah.
the companies, even like we were saying, Western Union's going to use a stable coin,
Right.
of course, because they can save so many fees and they can do it so much faster. It's just
DeFi protocols, pretty mature. Like I would say, everybody who's on exchanges and stuff, they understand DeFi protocols now. And corporate treasury, well, that's pretty big, and it's emerging, right? So when companies start saving in Bitcoin, that's going to be big. Stablecoins aren't competing with Bitcoin. They're its advanced team. Every piece of stablecoin infrastructure works for Bitcoin. Every stablecoin user is pre-trained for Bitcoin. Every stablecoin merchant can accept Bitcoin instantly. Banks integrating stablecoins think they're modernizing payments. They're actually building Bitcoin's infrastructure. Businesses accepting USDC think they're avoiding credit card fees. They're actually preparing for Bitcoin commerce. Governments allowing stablecoins think they're extending dollar dominance. They're actually accelerating Bitcoin adoption. The very system designed to preserve fiat currency dominance becomes the mechanism for Bitcoin's victory. Every stablecoin issued, every wallet downloaded, every merchant onboarded moves us closer to the Bitcoin standard. By 2035, when stablecoins reach 10 trillion, the infrastructure for Bitcoin's global adoption will be complete. 2 billion people will understand private keys. Millions of businesses will accept cryptocurrency. Banks will have integrated blockchain technology. Why don't you take us home?
Yeah. Well, there's blockchain technology. Yeah.
Yeah.
And then the real migration begins, not from fiat to stable coins, but from stable coins to Bitcoin. $10 trillion of liquidity, educated users, built infrastructure, all one click away from the hardest money ever created. And that's how stablecoins drive Bitcoin to $1 million, not as competitors, but as the perfect gateway drug. They promised digital dollars, but delivered monetary revolution. The infrastructure continues building while millions learn the necessary skills. Bitcoin's most effective onboarding mechanism, though few recognize this dynamic.
Okay, so that's stablecoins. We've forgotten about stablecoins now because everybody's in the shutdown. They want to see if they're going to eat turkey for Thanksgiving. We completely forgot about it, but
they're going to be back.
But they are coming back. Right? Stablecoins are back. The shutdown will end. We got to get over these things, and the stablecoins are one of the major bull drivers for Bitcoin in the next 12 months. I think.
Yeah, it is fascinating.
And so. Monday, we will read Fast Bitcoin.
Fast Bitcoin.
And so we're talking about scaling Bitcoin.
Man, I'm super excited about that chapter, honestly. I really love this idea that, like, well, we'll talk about it, but it's gonna be very interesting to see what people think about this chapter, because one of the things I just do not understand about Bitcoiners is why they think that a Bitcoin company that issues a private stock is better than a Bitcoin company that issues a token.
Kind of amazing, really.
It's pretty amazing to me, but I'd love to hear people's opinions about why stock issuance is better. Is it because you think that regulation is good? We'll talk about it on Monday.
Mm-hmm. And by the way, Larry Fink, who kind of led the ETF stuff, actually loves tokens. So there you go. Yeah. So, it's interesting that, we've had all these Bitcoiners. By the way, when the ETF came out, everybody was against it. Okay. I was like, no, this is a really good idea. And then it came out, and then not only they started loving it, but they started thinking, no, Bitcoin treasury companies are a really great idea. And we should have all these Bitcoin treasuries, preferred stock, all this kind of stuff. But no tokens, please, no tokens. But actually, wrap Bitcoin, actually not a bad idea. So that's it. We will cover. What are we going to cover next week again?
Fast Bitcoin.
Fast Bitcoin. So